Hello and welcome to this week's edition of Econoday Unplugged. It's Wednesday, the 7th of October 2020. Mark Pender is across the pond stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. A little more help, please, would seem to be the near universal call from major central banks to fiscal policymakers as rising COVID-19 cases across much of the world raise fresh question marks over the recovery prospects for the global economy. But some governments are clearly less willing or able than others to deliver. The US crucially being a case in point. Combined with what currently seems to be rising political uncertainty almost everywhere, this all makes for a very uncertain economic outlook that suggests that volatility levels should remain unusually high. And talking of fiscal policy, Brian, I noticed that there wasn't much out of this week's RBA meeting. Was that in anticipation of a loose fiscal budget, or do you think the package itself was actually sufficiently stimulative to ease pressure on the central bank to do more?
I think you're right. We have had the Reserve Bank of Australia for several months now, leaving monetary policy settings on hold. They cut rates in the initial stages of the pandemic back in April, but have been just sort of keeping things steady since then, and have come out and said, we think fiscal policy would be good to boost activity, and that's what's happened. The Australian government also in the initial stages of the pandemic went aggressively on fiscal policy, but they've done more this week with their annual budget. So that, we'll see what impact that has on, whether the central bank needs to do more in the next few months. I think, they'll at least give it a bit of time to see if that fiscal stimulus does work. But recognising that, of course, the overall the main factor that's going to determine how things go is just whether the virus gets under control in Australia, and we've had some good signs there, but it's still holding us back is what's happening in Victoria.
Okay, so presumably at this stage, then the chance of interest rates actually going negative, certainly not higher, and if anything, perhaps slightly reduced as a result of the budget.
Yeah, I think so. They've talked about using some alternative monetary policy tools, and they haven't ruled out reducing rates further and even into negative territory. But there does seem to be reluctance at this stage to go that aggressively on monetary policy. Recognising that there's only so much you can do if the virus isn't cooperating. And right. As I said, in most of the country, we are on the right track, but Victoria, as I've mentioned in previous episodes, is that's the main problem, and hopefully there things are starting to improve though as well.
All right, fair enough. Okay, so how then is recovery, and I guess by association these days, the COVID numbers going elsewhere across the region?
Yeah, it's difficult to just give an overall assessment of the entire region, but what we are seeing in most countries is a relaxation of the restrictions. There's still some new cases popping up here and there, but overall, if you look at the PMI numbers that came out at the start of the month, they've all gone in the right direction across the region, and that's definitely indicating that authorities in most of the countries have been able to ease some of the restrictions that have been in place, even in the last couple of weeks. India in particular has really bounced back strongly since it started easing its restrictions over the last couple of months. So both the manufacturing and the services sector PMI really improved over September, and so that's a positive. Hong Kong and Singapore, they're still indicating contraction in their overall economies, but to a lesser extent than previously. China, though, we haven't really. We're still waiting for the final Chinese numbers for the PMI surveys because they've been out on holiday for the last week. But I think the overall trend in China has been pretty positive as well.
Okay, well, so that's all fairly positive. You mentioned India in there, so I guess we should mention the Reserve Bank of India, whose policy statement was deferred last week until this Friday, if I remember rightly, with the appointment of new three external members to the Monetary Policy Committee. Now, I think I'm right in suggesting that by and large markets are anticipating the latest additions as being on the dovish side. So does that have any implications for a possible further easing from the RBI, or is that going to be swamped by just what's going on more generally and the fact that inflation's too high?
Yeah, it's going to be interesting to see that, because the RBI has definitely been in a bit of a policy dilemma over the last few months, wanting to cut policy rates further, but also recognising that actually they have had an unwelcome increase in inflation over that period. So what we tend to find is that because these external appointments are made by the government, they do tend to be a little bit more favourable towards the government's position, which normally is to provide more monetary policy support. But that remains to be seen. They obviously will come in with an independent view and obviously analyse things in the right way. But even the internal members of the policy committee have been broadly supportive of easing policy if they can, but just recognising that they've got to make sure that they stick to their inflation target.
So I should ask you, the inflation target itself, is that handed down by the government, I assume?
Yes, it is, yeah.
So, and is that a strict target? Because we're in this kind of world at the moment where we've seen the Fed. Well, obviously they're just not an inflation target. They've got the likes of unemployment and so on. Anyway, already in there. We've got talk that the ECB is probably going to modify its inflation target, at least to some degree at some point. So there's increasing pressure on a lot of these central banks to modify their current inflation objectives, be it in terms of average inflation targeting, or perhaps introducing a real economy aspect to it. Is that a possibility in India as well, given the problem with what's going on with all the COVID impact upon the real economy, but inflation being too high?
Well, I think what is in the RBI's favour is that the target range is actually pretty wide. It's from anywhere between the target range is 2% to 6%. Mm-hmm. So in a lot of other cases, you have like maybe 2 to 3%, or quite a narrower range. So that wider range, I think, recognises that in India, prices can be a bit more volatile, just given the high weighting of food in the CPI index. So they've already got a little bit of leeway, I think, in the width of the band, but they obviously try and keep inflation near the middle of that band, and so that's that is sometimes challenging when you see big swings in food prices.
Okay, watch this space, I guess, as they say.
Well, I think in general, right across the region, we haven't seen much moves in monetary policy over the last 3 or 4 months after that initial stage of the pandemic. So you're right, it is sort of just wait and see. And I think all the central banks in the region are just waiting for public health developments to guide them on when they can perhaps move to more normal monetary policy settings.
Yeah, sadly, like the rest of the world, I guess, isn't it? Okay, then. All right. So, Mr. Pender, what do we got? Fresh out of Walter Reed Hospital yesterday, then. President Trump apparently squashed any hopes of a new fiscal package. How damaging might that be to the economy? And for that matter, does it have any implications for what I guess must be a less than impressed Fed?
Well, the minutes came out from just before our conversation here, from their mid-September meeting, and policy was depending on fiscal stimulus. I'm not sure any changes in policy were. There was just a very strong expectation that were there not to be a second fiscal package, that the recovery would slow, and that's the Fed's own characterization of their own members. They also have their business contacts and their market contacts, and the description of their assessments was more severe, that it would be certainly a very bad thing if there was not a fiscal package. Now, What is the status of that package? Is it seems to be completely, not possible until at least after the election in early November. So it would still, in theory, be something that could still be around the corner, but there's no sign of it right now. And so that puts, monetary policy, I think. Yeah, I mean, there's really no place for the Federal Reserve to go. Yesterday, Chair Jerome Powell once again repeated that they're not considering negative rates. Today's minutes, there was some talk among the members of revisiting QE levels. I mean, they've already agreed that it should be increasing at the current rate, but maybe that needs to be accelerated. But that remains to be seen. It's kind of a frustrating position that the monetary policy makers are in right now. They really just have to sit and wait until after the election, until something happens, or if, as Brian was saying, in case maybe there will be a positive public health development. Certainly, President Trump's experience aside, the infection rates in the U.S. are stable. I mean, even though they're very much higher than other places, including Australia, they aren't leading to new lockdowns or restrictions. Which is what caused the shutdown, of course, and was caused all the issues.
Okay, in terms of the economy at the moment, obviously we had the employment report update back end of last week. What did that give us anything new in terms of the way the economy is actually evolving at the moment?
Well, I think it's what it kind of repeats what the minutes were saying, that there was a mid-month meeting and the monthly employment report is sampled at mid-month. So they may have very well had a look at the numbers beforehand. But they came in at non-farm payroll growth was 661,000, which was less than half of the 1.5 million in the prior month. So it's definitely been on the way down, and the minutes kind of there was I'm not sure the word disappointment would never appear in such a text, but I think that you could almost sense that. But what can they really do to improve employment? It's in complete dislocation, and it's churning right now, trying to find the labor market is trying to find a new direction, a new stability, and certainly that is still in play. And there's but in any case, what the improvement is being seen is slowing. And if you map this stuff out, these rates of growth, and the minutes are on my mind because I've just read them. So but there's still the complaint, or not the complaint, but there's still the observation that levels of activity, including employment, are still significantly below where they were before the virus hit. And if you look at some of these rates of improvement, it's not in production, especially in employment, in consumer spending overall, including services, that it's not going to be around the corner anytime soon that the economy at this rate of improvement will get back to where it was. It looks to me some of these numbers are pushed back well into and beyond next year, and other ones are at the beginning of next year. But it apparently is going to be a frustratingly slow process, and without government support for lower wage workers during this time is going to be pain. And the American public and the American labor market, outright pain isn't. They've traditionally suffered. So it's kind of a scary. I'm not sure that's the right word, but it's a
might well be.
Yeah,
Let us hope not.
It's troubling. How's that?
All right. Okay. Thanks for that. Before we let you go, just normally, I guess we wouldn't. Well, certainly on this side of the pond, anyway. The idea of a vice presidential debate, before the election, would attach virtually no attention whatsoever. But in light of recent developments and the way the actual presidential debate went between Messrs. Trump and Biden, there's actually quite a lot of interest in what the vice presidential debate, if I can get my teeth around it, will come out with today. I mean, do you think it's actually going to provide any kind of, I don't know, sort of semblance to the markets as to differences between policies and actually give investors the chance to think about what might be good and what might be bad in terms of an election result?
No, you asked me what the I get, when you ask me these questions, I get the expectation I'm going to be talking about the actual, personalities and things. But then you turn it on to the markets, and like
That's
the presidential
what we're interested
debate.
in. That's what
You're right. No, you're right. But but there's a lot of personality.
Yeah,
and,
sure.
Kamala Harris said this is going to be kind of introduction to, not everyone followed the Democratic primaries or the debates with that kind of close scrutiny. Well, that's going to come now. But as far as the markets, it's what I had said before with the Trump and Biden. It's going. It would have no, and I don't think it really did have any direct market pricing effects. I doubt even more that this would. Since they are, the vice presidents, I'm not sure that they're going to, introduce new policy ideas. Whether it's they could be talking about fiscal policy is certainly going to come up, and that may put Pence on the defensive, considering what President Trump has decided. But there is something unusual about this one because of President Trump's diagnosis. And that's going to put an extra severe, scrutiny on Pence. So it's good. It'll be worth them. I think it'll be a good show, or an interesting show. But as far as how it's going to affect the economic or the market outlook, I imagine it's going to have very little, if any, impact.
Fair enough. Okay, then, shifting across to Europe and sort of my part of the world, I guess it's not so different from what Mark and Brian have been saying, at least in terms of economic developments anyway. The bad news as far as Europe goes is that we have rising COVID cases pretty well across the continent at the moment. We have record high new daily cases in France, Spain, the UK, Poland, even Germany now, which is running at its highest level since April. And that's supposed to be one of the countries which has handled the second wave of the virus better than most. So it's led to increasing speculation that governments or monetary policy will have to be loosened over the course of the next few months. And I guess it's more and more sort of putting pressure on the ECB in the sense that the COVID rescue package, the jointly financed package that we talked about so often on these podcasts, still really, there's no obvious breakthrough in sight in this. Indeed, Germany, who holds the EU presidential position at the moment, they're even warning last week that it's unlikely that things will be sorted out come January the 1st of next year, which is when this new COVID rescue plan is supposed to come into operation. And that's really just a reflection of the fact there's still ongoing disagreements amongst the various members, particularly concerning Hungary, as we talked about in the past, about how these funds are going to be allocated and what kind of additional regulations will be attached to these funds for the countries to get them in the first place. So the bottom line to all that little lot is that if we're not going to get much help coming out of at least the joint rescue fund, then where is the stimulus going to come from? And it's probably needed because most of the economic figures continue to suggest that the recovery, although it remains on track for continental Europe and the likes of the UK, it's certainly slowing. There's still a substantial gap versus in terms of total output compared to where we used to be back in February time before the lockdown came into place. And the excess capacity is putting steady pressure, rising pressure, I should say, on unemployment. So it does seem as if the economic outlook for Europe at the moment does doesn't look too good, and there's growing pressure really on, say, bottom line ECB to come out and do something. And it's notable that we've had Christine Lagarde, the president of the European Central Bank, hinting over the last couple of weeks or so that a switch to average inflation targeting is a good idea. That doesn't mean to say it's going to happen, but of course we do have this wholesale review of ECB monetary policy being undertaken at the moment. The results of that are expected to be out early next year, but it does seem as if there's an increasing sense that this so-called near 2% target might be disappearing before too long. There's various other bits and pieces surrounding it. We don't know exactly what shape or form it's going to take yet, but it's quite clear that the ECB seems unhappy, at least the majority, I think, of the ECB seem unhappy that the current target is working, or rather should say not working as it should be. So I think markets going into the next couple of central bank meetings from the European Central Bank. So the next one will be on October the 28th, and the last one of the year when we'll get the updated forecasts, which is when they like to make their policy changes if they're going to do that. That's on December the 9th. There's going to be certainly, I think, speculation, which will tend to see money market rates being under downward pressure, bond yields remaining under downward pressure as well as we go through that period. So numbers disappointing on the whole. The likes of the PMIs suggest that growth, if anything, in September has almost dried up. If that is the case, the European economy is still, 10, 12% or so below where it was back in February time. And for the ECB, which of course is still currently charged with meeting this inflation target, all the price numbers are going in the wrong direction. So as far as the September flash inflation figures, we had that running down at minus 0.3%. That's the lowest figure we've had since January 2015. And more significantly, the core rate, or at least the narrow core rate, so-called, that's just 0.2% now, and that's a new record low. And for the likes of an ECB, which attaches a lot of weight to inflation expectations, if you believe the EU Commission data, that's been falling now steadily over every month over the last 5 months. So it's really knitting itself together into a picture that suggests that probably policy isn't working as things stand at the moment. So I think, looking forward, there's going to be a lot of speculation that the ECB will be forced to do something off its own bat, or simply because the fiscal policymakers can't get their act together before the end of the year. As far as the UK is concerned, surprise, surprise, I guess more than anything else, it's still the ongoing Brexit discussions which are dominating market sentiment. I guess it's quite interesting at the moment in the sense that the pound is holding up relatively well. And that appears to be a reflection of the fact that investors still seem to have faith in the idea that there will be some sort of trade agreement between the UK and the European Union by the end of this month. That's despite the fact that the last official round of trade talks, which concluded last week, to all intents and purposes, yet again, didn't really achieve anything. Now, there will be unofficial talks going on between now and next week. And next week's going to be important, or at least it should be important, because if you believe Boris Johnson, the UK Prime Minister, then October the 15th, which is the first day of a 2-day European Leaders Summit, that's he's earmarked as being the deadline for when agreement is reached, or he's simply going to walk away from the table and there won't be a deal come the end of this year when the transition period has ended. Well, of course, that to be the case is got to be bad news for the UK, but also the European Union as well. And that could potentially be a major plus factor as the dollar's concerned. So it still means that UK markets by and large are pretty volatile. The economic recovery in the UK, I guess in a nutshell, is pretty well mirroring what we're seeing in Europe. It's sort of doing okay, but there's a long way to go yet. And the signs are that growth is starting to slow far too early. But certainly splits, it still seems, on the Bank of England as to what they should be doing with interest rates. Some members still seem to believe that interest rates should go into negative territory. Others seem happy with the idea that they should stick where they are. But if we don't see interest rates going below zero, and I don't think we'll see that for a little while yet, there's certainly going to be more pressure on them to come out and increase their quantitative easing package. So it wouldn't be too surprising if we see that being hiked also before the end of the year. So I guess big picture, pretty well wherever you look around the world at the moment, is that if we are going to see any kind of changes in policy, it's going to be in the direction of additional fiscal or perhaps more likely monetary stimulus. Watch this space, as they say.
Oh, can I ask something?
Please
Can
do.
we, let's do a regional assessment of. It sounds like Brian's region's doing the better than mine. I'd say the North American assessment is. Obviously there's been a significant level of new risk to what was, I think, what is becoming, like you say, slowing far too early. So I think that would be kind of, what is that a negative assessment? But it's definitely not a sunshine assessment. So. So that's how I see North America.
All right, Bron, in a nutshell, how would you sort of summarize your part of the world?
Yeah, I mean, it's tracking in the right direction. As I said earlier, it's obviously dependent on the extent to which authorities are able to ease restrictions and just get people back into, normal operating procedures. But if you definitely look at the PMI surveys that we've had over the last week or so, they're all heading in the right direction. We're all seeing conditions at least stabilise, if not, starting to indicate expansion in the economic activity again. And again, I think that has allowed policymakers to sort of keep on hold for monetary policy, and then but still pushing for some more fiscal support.
Actually, I can ask quick, because I should have asked you before, but it's in terms
Yeah.
of China, as one of the potential standouts. So, I mean, how's China doing now, particularly in relation to the rest of the region?
Well, it's started its recovery earlier, and it's still going pretty well. We get the final set of PMI numbers, I think, tomorrow, because as I said, they've just had a week of national holidays, but we had a couple of releases out before those holidays started, and again, they're showing a pretty solid expansion in both the manufacturing and the non-manufacturing sectors. The latest set of monthly numbers that we had in mid-September were pretty positive. They've kept policy rates, policy settings pretty much on hold as well. So it's looking okay. Probably still not quite back to pre-pandemic levels, but a big bounce back from the initial impact of the pandemic.
Probably good news, and I expect the world economy needs that. Okay, I suppose I just mentioned in terms of talking.
Well, wait, Jeremy, what about Europe?
Well, so I kind of thought I summarize Europe, really. I mean, Europe is, I suspect, lagging behind the recovery in most of the other regions. I think the downturn was certainly steeper than the likes we saw in your side of the water, probably steeper than we saw in most of Asia as well. And it does seem that the recovery is also being relatively slow too. And the problem, of course, for Europe is that for a lot of the recovery period, it seemed as if Europe had actually constrain the COVID cases relatively well until in the last month or so, when we've seen what is now becoming a significant spike, and it has led to additional tightenings by a whole range of countries over the last few weeks, with a probability of more to come. So I think over the course of, let's say, between now and the end of the year, it may well be the case that Europe underperforms pretty well the rest of the world. So not good news coming out really from over here. And I guess just to try and round this off before we prattle on for too long, was an interesting survey which came out from Germany's IFO Institute. So these are the guys widely respected, and they produce, of course, the closely followed IFO survey, which tracks Germany, and indeed they do a world survey as well. Well, they did a poll of some 950, so that's 950 worldwide economists, which came out, I think, today, suggesting that the global economy would contract by 4.4% in 2020, and that would be one of the steepest declines on record, no surprise there, followed by a bounce back of 3.2% in 2021. So in other words, if that's going to be the case, we're not going to see global activity, at least the level of global activity, back where it was prior to the pandemic until at least into 2022. So it looks as if it's going to be a difficult time for certainly the jobs market and for activity rates in general. And very much suggests that pressure on economic policymakers, doesn't matter where you come from, is going to remain very much for additional stimulus, or very much keeping policy easy for as long as possible, if you believe that, of course. Okay then, anyone else for anything else? Good, that's what we like to hear. In which case then, that is it for this week. On behalf of Brian, Mark and myself, thanks as always for listening. We'll be back next week, and in the meantime, of course, you can keep up to date with all the key market moving data and events in Econoday's global economic calendar. Stay safe, and we'll see you next time. Bye for now.